Hi, and welcome to this week's look at the major news stories affecting the market so far and moving forwards. And we're going to start with the FTSE, and the FTSE 100 dropped below its June low this week. Now, obviously, we're aware it has the highest inflation among G7 countries. And in fact, JP analysts this week suggested that the base rate in the UK could increase up to 7% under certain scenarios. That's not great news. And the likelihood of a hard landing for the UK economy next year is rising. That's mainly due to the impact of rising borrowing costs, and obviously that affects business confidence, but also rising unemployment. Secondly, we're also seeing a decrease in commodity prices. Now, commodity prices are important for the FTSE 100, where the share of oil and mining companies is relatively large compared to other major indices. Commodity prices also reflect expectations of global economic growth and its outlook. Now, that's obviously been dented by news from China this week that activity in services sector in June grew at its slowest pace in the last 5 months. So those sort of indicators are not looking great. But at the same time, the FTSE 100 chart does give hope to the bulls, as the price of the index is at a level of the lower line of the descending channel that we see in red on the chart, which may show support properties moving forwards. Now, this could well slow the fall down or possibly facilitate a short-term rebound. But obviously, lots of economic factors and news about at the moment, clearly having an impact on the FTSE 100. And where we've said previously, it's sort of, if you like, old-fashioned makeup has stood it well over the last 12 months. With commodity prices falling, that's beginning to bite slightly. Okay, secondly, we're going to turn our attention towards currency markets and the dollar-yen. And are we seeing a bit of a calm before the storm? Well, there's been a bit of a lull or a consolidation in the dollar-yen market over the past few days. Now, this is evidenced by the width of the Bollinger Bands, which dropped to the lows of the end of February on the 4-hour chart. Now, we have had bank holidays and the 4th of July celebrations in the US, and that's contributed to a decrease in volatility and slightly lower volumes over the last few days. The chart shows the bulls have tested 144, and on Wednesday morning, the rate pushed up towards the 145 level. Reuters reported the words of Shizuke Yamada, the chief forex strategist at the Bank of China, who believes that the market expects further weakening of the yen in the medium term. Now, that's quite important because last autumn, 145 became the trigger for intervention from the Bank of Japan. So for expectancy weakness in that 145 level reach, could we see further intervention? Now, Wednesday evening UK time was closely observed for drivers of further volatility, or to increase that volatility a little bit more in the dollar yen, following the FOMC minutes. But as of Thursday morning, there was no major reaction. We've seen a slight decrease in the rate to circa 144 after the previous close of 144.6 last night. So there's still some legs in this, and nobody quite sure where it's going at the moment. But I think the next few days, the next couple of weeks could be quite important in terms of, are we going to see further intervention, or actually are we going to see this sort of gain ease back off? Okay, sticking the other side of the pond in America, the NASDAQ's hit a 1-year high, but is it sustainable? Well, Monday saw the NAS composite close at 13,816.77. Now, that's almost 2,500 points higher than this time last year. And it's fair to say, we'd had a couple of years in the doldrums, really, when it came to the NASDAQ. We've covered the reasons why quite some time. But the last 3 months has been particularly strong. Tech stocks, no doubt, coming into play. Tesla, that we're going to speak about shortly, is an example of one of the key drivers of why the NASDAQ composite and the 100 and the E-mini are doing so well. Now, Wednesday saw a high on the NASDAQ 100 of 15,268. That did close down at 15,203, so it did ease off slightly, but again, very, very positive numbers. Now, memories do seem to be pretty short, because some of the bank stocks that are listed are up, and they're paying higher dividends than they were this time last year. And that's despite the banking crisis earlier this year that's not that long ago. But people seem to have put that to one side. But how long will that last? Are we going to see any sort of fear again from the banking sector? Well, Thursday pre-market, we're trading is average. It's slightly easier. And the mini 100 NASDAQ contract trading about 15,145 at the moment. So Is that high going to be sustainable? Are we going to see further growth? Nobody's quite sure, but certainly expect a little bit of volatility in the coming days, so don't forget your risk management techniques. So we've just mentioned the NASDAQ and even hinted at one of the main drivers, if you like, of growth at the moment is Tesla. So we're going to take a little bit of a closer look. Now, obviously, as I've said, one of the major players in the NASDAQ. And now, according to Bloomberg, the world's richest people got richer in the first half of 2023. And it will come as no surprise that Elon Musk was one of those. Looks like his personal wealth increased by about 96.6 billion US dollars. Mark Zuckerberg, also on that list, that he was up $58.9 billion. Well, so far this year, Tesla up just over 150% in terms of its share price, and Meta not far behind, up 140%. These are two major players and both experiencing a very good 2023 so far. In fact, Mark Zuckerberg, it launched Thursday, gave the green light for Threads, a direct competitor to Twitter. Now, this launch has led to a little bit of to and fro between Zuckerberg and Musk, and in fact, there's now an MMA fight on the cards. But let's stick to the economics of it all. Now, Tesla's bull market seems to be continuing. New high for the year off the back of record EV electric vehicle shipments in Q2 of 2023. Have a quick look at the chart. Now, that shows the price of Tesla broke through the descending channel with a gap that's shown in red, and it fixed above it in the ascending channel in blue. Now, the price is nearing the upper border of the rising channel, which is providing a little bit of resistance, a little bit of resisting going on. The price is also approaching the psychological level of $300 a share, which, if we look back last year, beat the bulls in the bull market at the time. Interesting though, according to analysis published by CNN Money, the average target price of Tesla is $220. So we're seeing a bit of a discrepancy there. Does that mean it's vulnerable to a pullback? A little bit of resistance, target price quite significantly below its current levels. We know tech stocks have been historically quite volatile. Don't think that's really going to change. We're seeing it start to creep back in. But there's no doubt about it. So far, 2023 has been a good year for companies such as Tesla and Meta. We wish you luck with your trading in the week ahead. Bye for now.